The Hedgeless Horseman here. It's 12th of March 2026. First video after I got back from PDAC. Yeah, first of all, thanks to the sponsors. I felt like making a video because finally the markets are getting quite interesting again. And yeah, I mean, maybe some, I was gonna say, might need some copium or something like that. So I felt it might be good time to just, yeah, do what I did again. I guess for felt like a couple of years during the last bear market. I mean, the thing is, if there's one edge I think I have, or it's like, what is my most important edge? I would think that's emotional self-control, being non-attached, and temperament. And yeah, I mean, this would be the time. It's I don't know how much of the actual long-term returns are decided during corrections or bear markets, but it's probably, I mean, if I look, let's say I purchase, let's say I bought, juniors at the 2016 top, and let's fast forward 4 years to another top. I don't know what I would be up. Let's say I'm up 100% or something in 4 years from top to top. That's not too bad, right? But if you look at, from the bottom in, let's say, 2018 or 19 to a top in 2020, I mean, it might be 500%, something like that or more. And obviously the portfolio will average because I'm buying high and I'm buying low. Important thing, of course, is that, again, with a correction or a bear market, every single day that we get closer to a bottom, it means we're getting closer to a bull market, and from a lower price, which means higher returns. I should actually probably use GDXJ or something for this, but point is that, let's say this was the bottom, this was the previous top. I mean, this price is obviously lower than here. It's forward in time. It means the bear market, or this correction, has lasted longer. So what does that mean? Obviously it means that we're, whatever, a couple of months or a few months closer to the next bull market, and again from a lower level. So the future compounding goes exponential because it's closer in time. I mean, we can take even yeah, let's take these two, which is pretty much the same price in gold, to this, whatever, short-term top. Yes, from the same price, but this is obviously closer in time here. So let's say you made, I don't know what that is, but let's say 24% in July 2023. Let's say a year. Whereas like this is the same return, but in whatever, 2.5 years or something like this. I mean, yes, same return, but obviously from a compounding perspective, insane difference. I mean, it's a multiplier, right? And especially why it goes exponential if it's actually at a lower price, because this is even a higher return than even in a shorter time period. So, I mean, point is, during corrections, bear markets, etc., etc., I mean, the deeper they go, your future expected compounding from those levels goes up exponentially. And that's why I kept saying during the last bear market that if we're already at extreme lows, let's say, or ridiculous prices, and it keeps going lower, that means that the opportunity is going exponential, which means that selling is exponentially worse than holding, and holding is getting exponentially worse than buying. And oh, by the way, you have to excuse my. I got the PDEC flu, so I'm a bit under the weather. Why I like times like this? I think it's interesting because nothing really. What separates long-term winners from long-term losers is emotional control. It's basically what you do during panic sellings, right? And okay, when does that matter? That's obviously when panic selling is happening. So it's like if there's a time where it really, really matters what you do, it's at emotional highs. Well, when emotions spike, etc. Volatility, high volatility. That's really what it's gonna probably tell you everything about your investment approach. For example, I mean, when during the run up, for example, which we saw, a couple of or several months ago when it started in the miners, it was very easy to be long. Everybody looked like a genius. You saw constantly, I mean, you probably remember this, constantly saw brag posts about the annual returns people had. And already now, I haven't really seen many brag posts. Obviously, usually it happens when, I mean, like social media, you put up the highlights, etc., etc. And now, I mean, I'm already seeing some people kind of giving up in a sense. Like people, they maybe have given back 50% of the last 6 months' returns, for example, and they feel like shit. And that's why I also said it's like 95% of the time you will look stupid, meaning that your portfolio will not be making new all-time highs about 95% of the time. So basically every single day is in one way or another a disappointment, and that's something you just have to suck up. And that's why almost everyone becomes a short-term trader, because nobody can cope with that. They want to make money, if not every day, at least every week. Otherwise, they feel like something is wrong and that they're failures and they can't brag, yada, yada, yada. And that's why most people lose, because everybody is a momentum trader, short-term momentum trader, and increasingly so. And that obviously explains why we have this kind of volatility, like we're seeing, in the recent week. Why? Because the short-term trend is down, and people are not selling juniors, especially, let's say, the higher quality juniors. They are not selling them because they think they are overvalued, because most of them are not overvalued. They're selling them because they think they're going to go lower tomorrow. Even if they bought it at one point a few months ago, thinking, hey, this looks cheap, and now they might be selling it at an even cheaper level. And of course, that doesn't make sense. But that's because it doesn't make sense. They switch from actually, I mean, it's easy to be a long, there's a saying, I guess, or you see that now and then, where it's like it's easy to be a dip buyer or a long-term investor when the trend is up, short-term trend. When it's down, people, switch strategies and all of a sudden become traders. And that's why almost nobody actually makes any money. Almost nobody beats an index, and when you have one of the most volatile sectors there are, which is the junior mining sector, you can take that and increase it by order of magnitude. Okay, let's go back to business or basics. Value investing, let's say. True value of a business. Of course, mining sector is very, in a sense, speculative, and I mean, you don't, especially if a project is not, project is not a mine yet, then it's even more speculative. But of course, I mean, the idea is that intrinsic value is the long-term value, monetary value of an asset. And we don't know what the gold price is going to be in the future. We don't know when a project necessarily might be into production and all that, if it will ever get into production, yada, yada, yada. Still, one can have some kind of assumption. I mean, one thing I like to remind myself of is that a tier 1 project is a tier 1 project regardless of what the metal price is, regardless of what the Fed funds rate is, regardless of what the oil price is, etc. If there's a project that's going to get built one day, it's a tier 1 project. You know, assuming permitting, etc. works out. But from just an economic standpoint. So my point is that even though a lot of people might ridicule the idea that's like, oh, you know, quoting Buffett and value investing, etc., with something like the junior mining space, at the end of the day, that it's still true. I mean, why do big companies acquire something? Because the perception is that it's worth more than they paid for it. So even though it's hard to pinpoint exactly what the price of a or value of a deposit or a project is, there is still a value of a deposit, even though it's very, let's say, volatile and speculative. And especially the miners or anybody who funds construction of a mine or acquires a project that they would like to see become a mine, they obviously have a sense of what the net asset value is of that deposit. So it's still the invisible hand in a sense. It's just that it's very much more chaotic than Coca-Cola or McDonald's or whatever, where you have pretty steady growth or whatever. You kind of know what the next year or next 2 years are going to look like. In short, I mean, I simply think we're in the higher quality names. Again, I think we're down here somewhere right now. Because we can look at the metal prices, and sure, we don't know what the metal price is going to be if a project is in production maybe in 3 years. What does the spot metal price today, how much does that matter? Well, that's the most recent data we have on what the gold price might be, for example, in 3 years. And of course, one thing to note that the gold price might also be at $7,000 in 3 years. So it's not just that, well, it's at $5,000 now, it could be lower, yes, but it could also be higher. But the spot metal price is the most recent data we have of what the gold price might be in the future. That's it. So, yeah, I mean, just this graph alone is what I think people should be considering right now. Because most people have no idea what they think a junior is worth, or what it could be worth, or why they bought it, or anything like that. Then you don't have this, true value of a business line here. So they have no idea. I mean, that's why here maybe people bought, or here maybe people bought because it was a dip and they're long-term investors and it's cheap, etc., etc. But down here they're like, panic mode. I'm gonna sell out, yada yada yada. And we know it's like this is a junior during the, I think, 2020 or maybe 2016 upleg in miners. Look at the amount of corrections. So corrections is gonna happen. Corrections happen basically as much or as frequently as in a bull market as it does in a bear market. Just that the net surprises is that after the corrections or consolidation, it tends to make a new high, and then correct again, consolidate a new high, correct again, consolidate a new high, etc. But you have, and if this was a bear market, it would still consolidate a lot of the time. It's just that once the consolidation is over, instead of making a new all-time high, it would just make a lower low. So it's like the price of riding a bull market is that you're gonna get your teeth kicked in pretty much as often as you do in a bear market. why I made the point that most of the time a bull market feels like a bear market. They're indistinguishable. And why it's going to feel like 95% of the time you're losing. We simply happen to be in a time where we're not making new all-time highs. One second. Yeah, and like I said before, I mean, this is outdated now because this is 2024, and obviously SIL, or what is this? I guess this is SILJ. I mean, it's way, way, way up now. But I guess it's relevant because it just shows that, yeah, 80-20 rule, I was going to say, 80% of the time this sector has sucked. Here, no buy over this period showed a profit. All of a sudden, almost every buy showed a profit. Down here, no buy since here, or even any buy in this period of time, which is many, many years, except down here, showed a loss. And I don't know, 6 months later or something, almost every single buy over almost the same time period showed a profit. And obviously, the long-term value of SILJ doesn't actually swing like this. I mean, it's like a black, this was a black swan, this was a black swan, black swan, black swan, which just goes to show that, as Bob Moriarty likes to say, what's the quote? Nobody knows anything. And now we happen to be, well, GDXJ hasn't actually corrected that much. I mean, it's down what? 70%. One thing though is like GDX has already broken out of the all-time high. GDXJ has not. And the juniors, I mean, the juniors are lagging even more behind, I would say. I mean, many juniors probably, relatively speaking, might be down here or something. So it's like, when I think about what's a proper mining bull, yes, GDX has broken out. GDXJ hasn't even taken out the 2011 highs, and the juniors, many juniors are not even past their 2020 highs. Is that a biblical bull market, or a, I wouldn't say so. Doesn't really feel like it. That's why I kind of feel like we're still quite early. But obviously, on the way, we're gonna have stuff like this happening when, it feels like the sky is falling. So yeah, first and most importantly, if you have an unemotional edge, it's going exponential lately. I'm loving this. It's like I'm like today I was, been listening to some heavy metal, for example, to really get me up into, fighting mood, let's say. And I haven't really done that much value shuffling, because it hasn't really been, the market hasn't been emotional enough, in a sense. Where it's like, I mean, when you have somebody who owns whatever stock, panic sells, or he's taking losses or margin calls or whatever, and he needs to dump something. I mean, and maybe he owns, let's say you own 10 stocks he owns, but he's, no, let's say you have 10 stocks, and this guy, the panic seller, margin call, or whatever reason he might be selling for, he owns one of those stocks, and all of a sudden you see that stock down 10%. And you like those 10 stocks an equal amount. So because somebody had a margin call or just panicked, whatever it might be, all of a sudden that stock is down 10%. For no reason. There's no news out, nothing that's specifically to do with that certain company, not those assets belonging to that company. But you get a 10% discount because of one person, let's say. That extra 10% discount, you never know. Compared to yesterday, this new 10% discount priced might give you another 30% within 2-3 years compared to yesterday. Yeah, an extra 30%. We're assuming it's an intact case. An extra 30% in, let's say, 2-3 years. That is absolutely nothing to sneeze at. I mean, it just goes to show. I mean, it really goes exponential. What you do in corrections, etc. That's, I don't know how much of the long-term returns that's going to dictate. Maybe 80% or something. So that's why, I know this is what you do during corrections, and of course at the same time, yes, what you do at highs might matter as well. But I'm bad at selling high. I'm mostly good at buying low, because at the end of the day, if you bought Dogecoin at the peak, the downside is 100%. If you bought Dogecoin when it's down 80%, the downside risk is still 100%. So buying high, it at least is capped for an individual buy or position or whatever. Yes, it wouldn't be great if you just put the entire portfolio in at an astronomical high, and it might take you 40 years without any buying, etc., just to hold it to get back. Let's say you bought Nikkei, Japanese index, at the 1980 high, added no money, did nothing, just held it, and it might take you 40 years to actually go back, get back to even. Yes, that's true. But the point is to not only obviously buy at highs. I buy high all the time, but I can afford it because I never sell low. Because obviously, whereas buying high is capped at 100% for any dollar invested in a specific play or sector, whatever it might be. Buying is on the upside is unlimited for all intents and purposes. There's stocks where at one point in time you would get a plus 50 return in the next 3 years, whereas the same stock maybe 6 months later it's down so much that if you bought at that point in time, you might get 600% over the next 2.5 years. So where's the downside is capped unless you're using, whatever, go into debt, which I never do. The upside is unlimited. Why? What you do during corrections, in my opinion, and bear markets matter a lot more than what you do with the highs. If you sell or if you buy low, it takes care of basically everything. I mean, buying cheap is the best offense and defense you can have. It's not even close, I was gonna say. So, and maybe it's easier for me because I've seen this happen. My net worth, my portfolio has gone down 30 to 50% multiple times since 2015. And I know what happened every single time after the correction or bear market was done. The portfolio went up a lot more than it went down. Why I never feel a need to time anything. But with that said, since we're finally seeing some, I would say, panic selling, emotional selling, because why is the market so sour right now? Why is stuff down maybe 50% from the top? Is it because silver is down from 115 or whatever it was to $80, or gold is down from 5,600 to 5,000? I mean, they were not pricing in $150 silver or $5,600 gold to begin with. So from that perspective, it made no sense, or makes no sense. But we have the marginal investor in the junior space, which is probably one of the most emotionally sensitive investors in the entire world, I guess, after crypto. And we have what? We have a war in Iran, Straits of Hormuz, whatever it's called, blockaded, or oil prices spiking. So okay, so what's the main event on Twitter nowadays? That's it. The oil price. That the oil price has shot up, got shot down, and shooting up again. So whatever the narrative is, you can tell what everybody's talking about. And that means that everybody thinks that's important because everybody's talking about it. So that's why everybody, I mean, the joke is that any geopolitical event that's happening now, everybody becomes an expert on it. I don't know how many, I don't know how many posts about oil I've seen recently, and how many posts about oil could go to 150, yada yada yada. And that's what I'm starting to see also in excuses when it's like with the miners. Well, oil could go to 150, yeah, but there's a different excuse every single time. The excuse why people sold the 2015 bottom was completely different to why people sold and not bought the 2018-19 bottom, and it was totally different to the excuse people came up with, the narrative, why people sold and did not buy the 2024 bottom. It doesn't matter. There's always going to be some reason why people try to emotionally justify for not buying cheap. And I don't give a shit. I don't care. It's like, what is priced in some of these juniors? I don't know, maybe $150 oil and $4,000 gold and $40 silver. So I don't give a shit. But as always, people don't care about that. People are buying and selling stuff depending on if they think the short-term risk is to the upside or the downside. And if you're in a short-term, if you're in a downtrend, people are gonna guess that tomorrow the price is gonna be lower. And the longer that happens, people are gonna, I mean, think of it like this. You're somewhere on vacation, it's rained for one day, okay? And you came from, let's say you went to Thailand. I mean, at home in Canada, whatever, it's like sunny days, you go to Thailand, it rains one day, but you're like, whoa, rain, I haven't seen that in a while. But that's like, oh, it's probably just a one day thing. But let's say you're there for a month and it rains for 3 weeks straight. What do you think the day after, what the weather is going to be like? All you've known for 3 weeks is rain. So that's the new normal. You're obviously going to think that it's going to rain tomorrow because you have not seen any evidence over the last 3 weeks that there can even be a sunny day. That's basically what drives the market short term. So the longer the downtrend, the more sure people get that we're not closer to a uptrend, because it's been raining for however long this was, 2 years, or let's take here like 4 years. And in the meantime, what's happening? Well, we're getting closer and closer to the next bull phase, obviously, and from a lower level than, let's say, here at least. Or take the same price, let's say here versus here, same level, 2 years forward in time, 2 years closer to a bull market. Let's assume this wasn't actually the start of the bull market. Let's say that this was. People are much more inclined to sell here than here, even though by default or by definition, the longer a bear market has been in place, the closer you are to the inevitable upturn. That means the future compounding is going exponential, because this would be 382% in 2 years, versus from this level it was 4 years. Huge difference in terms of compounding. I mean, if you extrapolated that your portfolio went up 382% every 2 years versus every 4 years. I mean, in 20 years later, the difference would be in, I don't know, hundreds, thousands of percent or something. It's that big of a difference. And that's why selling late and low becomes so absolutely expensive, and why that's, if there's one thing again I absolutely make sure not to do, is sell low and late. And even if you thought, hey, it's extreme here, and you bought and you look wrong for 1.5 years, if you bought all the way down, let's say your average is here, one day the bear market or bear leg ended and you were up on every single buy. Same here, you could have started buying here. Yeah, you're gonna look, again, dumb, foolish. You can't brag for 2.5 years. But let's say you brought the average down here. I mean, preferably you would increase your buying if you could, the cheaper you got. But let's say the average is down here. Yeah, one day this leg was over, boom, up. I mean, if your average was here, you would have made, I don't know, 100%, let's say. And this is just in an index. So add the juniors now, where it's like they're even cheaper, I would say, than the larger miners on average, if we look at high quality. They're more volatile, they're more mispriced, so the opportunity ought to be even better. And add volatility, more volatility to an even more undervalued part of the mining sector, and you have risk rewards and future expected compounding in cases going absolutely bananas. And yeah, I mean, I don't know, I don't know what to say. It's like I like this. I mean, I haven't. Now it's starting to actually get fun. And to be honest, it's like I was I was a bit worried, I guess, that might be getting too soft. I was kind of getting disinterested in some ways. I didn't feel like, I don't know what to say, but I'm not that comfortable buying when stuff is going up. I don't feel like a contrarian. I don't feel like I have more fortitude than anybody else. But now all of a sudden, a few months later after the recent top, now it's getting interesting. Now it's getting hard. You see people throw in the towel. You see people like, oh, maybe I should bet on oil instead. People go to different sectors. Then it's like, okay, I'm getting, lonelier and lonelier, let's say, as a junior mining bull. So that just feels better, and it also reminds myself, where it's like, okay, great, I can still be bullish when people are getting increasingly bearish. So that to me says that, okay, I still got it from a mental fortitude perspective. The more I see people say this sector is shit, the more I want to be in it. And not just for, let's say, the money, in the sense that, well, I mean, to quote Rick Rule, he likes hated sectors and all that, because that means, and that's not just Rick Rule, but Warren Buffett and Peter Lynch and all of those obviously talk about, hate usually ends up or leads to, cheap sector, etc., cheap stock. It's not necessarily that. I think it's about proving something to myself, that I am not mediocre, that I can, whatever, take more mental punishment than the marginal investor, for example. So when I have these times, come around, I feel like, I don't know, I'm proving something to myself, that I can actually, go against the herd, let's say. because I think one fear I have is to be cheap. So now, as the emotions are starting to spike, the worries are starting to spike, people finding new excuses and telling everyone else about their excuses, why you should probably hold off, etc., buying juniors. I mean, that's music to my ears. It's like, that's great. Bring on the. I honestly, I'm I almost wish that we get some fat. I might regret it, but I'm kinda excited about having some kind of huge, volatility event where it's like a great financial crisis. Not what it means for the world economy, of course, but to so I can, another like really good test of how rational I can be, let's say. So imagine fast forward and we have a full-blown financial crisis. A lot of the juniors from these already ridiculously cheap levels are down 50%. Now that's a good test, because obviously some stuff is really really cheap already. Let's say paper, gold, and silver sells off. Let's say the junior sells off 50% because liquidity and margin calls and what happened in 2008. And at the same time, it's like, okay, well, this is bringing us closer to the end game and the aftermath, which is probably I don't know what, new currencies, implosion of some kind, where you would think that, well, every time, other time in history, it's been gold and silver who's been the last man standing. It's like if you were in the Reichsmark during the Weimar hyperinflation, you get wiped out. I mean, you had as much real wealth if you were a billionaire in Reichsmark as the person who had one Reichsmark, right? You get absolutely eviscerated. If you had real assets, you kept all that. So on relative basis, you won a lot by not losing everything. So if you know what happens after we go into let's say liquidity crunch, etc., and let's say the revaluation to real and the whole fiat Ponzi basically implodes. If somebody had 100 gold coins or whatever, and he kept that value going into a new monetary system, he's going to be much more better off than the person who had only fiat going into that reset, right? So you kind of know what the end game is going to be, and I'm very fearful not to be in real assets when that end game comes. But my point is that if we have something like a big paper flush because of a liquidity crunch and panic selling and what it might be, and I'm down 50%. Well, in my book, if we're already at really cheap valuations in real terms, and it goes down, and some of these units go down 50% from here, kind of like 2018. Unfortunately, GDXJ is not down here. I mean, from the panic sell bottom in 2008 to the top in 2011, a lot of juniors went up 1,000 to 2,000%. So that's what I'm seeing is at the other side of a potential 50%, let's say, crash from these already cheap levels. So there's not really a long-term problem. The problem is, of course, if you sold the 2008 bottom, because you sold a future 1 to 2,000% return in some juniors in just 3 years. I mean, selling that is maybe the most costly thing you could have done in the mining space over the last 40 years. So I'm more afraid of missing what comes after, let's say, something bad happens, than owning something cheap going into something bad happen, which goes down simply because people are panicked or whatever. And in the meantime, I mean, if I can't, whatever, if I can't suck it up, and I actually end up selling a flush, well, then I'm like everyone else and deserve to not make any money. To me, it's like, I don't necessarily want to be the smartest or something like that. I take a lot of pride in actually not breaking mentally from volatility. And that's probably again, I would think that's probably my best edge. There's people who know a lot more about geology than me and mining engineering and whatnot. And there's plenty of geologists and mining engineers out there, which I think are pretty poor investors. And the best investors I know, they're not necessarily mining engineers or geologists. But they have a lot of patience and they can buy low. That's, I think, again, that's more important than any, having a PhD in geology or mining engineering. At least if you're an investor, I mean, that's it. It's a completely different thing. It just happens to be in the mining space. So it's like, yeah, I've started finally to actually do some micro trading, some micro shuffling, etc. And let's look at a few cases. This is not really a big dipper here. It's the Tectonic Metals. It just happens to be interesting. I mean, they've raised $92 million recently. That's more than I've participated in, I think, 3 placements with Tectonic. Unfortunately, I don't have all the shares. I mean, I participate like here, and maybe here or something. I have, quite a bit of warrants at least, who all of a sudden happen to be in the money. But that's the sign of the times that they are at least getting better. Because this is, their raise is like 3-4 times what their market cap was a few years back. And of course, they've had success and all that. But I guess my point now is that, this is, a quite interesting case now. It's like, okay, we know what the market cap is right now. It looks like the Flat Gold project is a very big project because there's multiple targets and they've confirmed gold mineralization at multiple targets and had some really highlighted holes. I mean, that it could be a behemoth, right? So Tectonic is quite an interesting case because, you figure that, again, fundamentally, I don't give a shit about what the Fed funds rate is necessarily, what the oil price is, yada, yada. We know the market cap. That's the only thing you know at any one point in time. We know they have $92 million. So it's like, I don't know how much drilling they're going to do with $92 million, but probably a shit ton of drilling. How could the perception be of the Flat Gold project after this $92 million is spent? Do I think there's a chance that even with a lower gold price or whatever, that they might have proven up something that's worth quite a bit more than the current market cap? Yeah, I could see that. It's probably going to be quite action-packed. And then, of course, you have no idea. Let's say, fast forward 2 years, and it's kind of obvious that, hey, this is like a 5 to 10 million ounce gold system. We don't know what the gold price is going to be, and the sentiment might be shit. We might be in a global financial crisis. But gold might also be at $7,000, and all of a sudden a project like this with 5 to 10 million ounces is like $10 billion on paper. Of course, excluding the timeline to permit and all that. But like, I don't know. But it seems like quite an asymmetrical trade. What are the odds that they're going to spend 92 million and it's going to be obvious that the current market cap is way too high for what they've proven? I don't know. But I think it's a very interesting case. White gold, I owned a long time ago, but I pretty much missed this entire move up. But I talked to someone at PDAC who says, it looks like they're on a, this could be a, really big system. I mean, they have a bunch of targets, they have a resource already. And then you look at Cerro De Metals, which is in the general area with the coffee deposit. It's a more advanced project, but they have like $1.5 billion market cap for 3.7 million ounces, I think. the GO I was talking to, he certainly believes there's like 10 million ounce potential for white gold. And I think they have less than 1/3 the market cap of Cerro Metals. So better, higher base than Tectonic, which doesn't have even a resource yet. But we know what white gold is starting off with, and it looks like that this could get, really big. And then we have Cerro Metals as like some kind of a guideline, I guess. Like, okay, what is 3.7 million ounces of pretty de-risked project though worth? Well, that's more than 3 times what white gold is trading for. So that's one I think is interesting, and or not new, but like revisiting that one. Cerro De Pasco recently talked about that one. They put out some news with involvement with a U.S. government entity. So I would think that means there's more pressure to actually get their big tailings projects up and running. And I would expect it to be a low OPEX operation. And I think the AG equivalent, I might be wrong, but it's like 450 million ounces or something. I mean, it's a very large project, and I think the market cap's around 500 million CAD. With some critical minerals as well. I mean, there's steps left where like metallurgy and all that, and of course they would have to build it, yada yada. But I think it's pretty straightforward project. So if they actually get to mine that, and if silver prices are anywhere near these levels, that could be worth a lot more than the current market cap, I think. So also a asymmetrical bet, I would say. Probably could suffer a lot lower gold, silver prices as well. Sierra Madre, now we're getting more into white gold and Tectonic. I mean, they're not, yes, they're down from whatever, but they're more exploration stories in a sense. Sierra Madre is more like a known entity, more like a bird in the hand, more beta. But that's down 45, or was down 45% from the last high. And I think it's cheap. I mean, they're both a producer, a growing producer, and an explorer. So if they keep executing, and I look farther ahead, let's say they're up to, as some people think, 4 million ounces, at least AG equivalent production in 2 years, and silver prices are, pretty high. I mean, they don't need to be as high as this. This is probably going to look cheap. And again, it's like, this seems to be an intact story with a, let's say, long runway, and it's just corrected 45% on no company specific news. So these are more the ones where it's like, just automatically I get more keen on. It's like I did in the 2015 bottom. I literally looked at silver developers or advanced explorers and producers, and I just tried to find the companies that were down the most from the 2011 highs. Like Endeavor Silver was down like 97%, I think. First Majestic maybe down 95, 96. And in my mind, it's like, they're just so absolutely crushed. There can't be too much more downside. And the thing is, of course, that I started buying in 2015 late. But I bought juniors. But I started buying like in August. And this last dip here had my portfolio down 45%. Before the bottom was in and the portfolio went up 500%. But that goes back to my point. I knew they were extremely cheap and they were just getting cheaper. So I just kept adding. Boom. 2016 rally came. And I stopped playing poker and focused full time on investing. Everything changed within a year, basically. I just averaged down looking stupid while I was averaging down. Almost cut my net worth in half. Boom. 8 months later, retired from poker. So at least I've been able to buy low since I started. Silver VIPR Minerals. Maybe this one actually got ahead of itself. I didn't talk too much about it up here. I have a pretty fat position in Silver VIPR. But I could not, let's say, pound the table up here. Given the stage of the projects and the market cap. So maybe it was, I guess, a bit overstretched, but was fairly and is fairly tightly held. Eric Sprott bought into it. They're doing a deal with Oryx, getting a new project. But yeah, now it's down 56%. And again, just going back to, this is how bull markets work in a sense. And if you think some of these companies have assets that are worth more than the price, then we're simply, again, down here somewhere in a lot of names. So if I had to guess, well, it's like I kept talking about this time. It's like, what direction is the next big move going to be in miners? It's pretty obvious it's going to be up. Because they're dirt cheap and should bottom yesterday. But they didn't necessarily bottom, but sure as shit, the next big move was up because they were so undervalued. So if you find juniors you think are undervalued, margin of safety, should be going like that or whatever, that their value is up here, and you're down here, there's not that much more to think about. It's just obvious buys. But you don't go all in on every story, of course, because we can't know the intrinsic value that accurately, because there's always risks, as we're seeing out in the world. And there's counter risk and all of that. But on average, if you can just find companies where you think the value is around here and they're going like this, that's it. That's all you need to do. If you can buy and hold cheap, you don't even need to be right on every story. You just need to have the fortitude to actually average down and wait until this happens. So obviously, the more these juniors go down, if they have intact cases, we're getting, again, closer and closer to the next leg up from a lower price, which means that buying becomes exponentially better than holding, and holding is exponentially better than selling. And now we're starting to see people sell. Because again, they're not selling because they're overvalued, they're selling because they think it's been raining for X amount of months and they think it's gonna rain tomorrow. And the bigger paper losses people have, the more fearful they get of larger paper losses. So they're getting more inclined to sell, the better the buying opportunity becomes, because they can't take any more mental punishment. And that's again why mental fortitude is, in a volatile sector like this, is probably the biggest edge you can possibly have, together with patience. Blackrock Silver, down, 32%. Put out some good news recently, getting at least one critical permit out of 3, I think. There's some of the highest silver and gold grades of any silver gold project out there. Are they not going to make money because gold is at $100 and silver is at $80 if this gets into production and works? No, that's still way overkill. I just played around with an ASIC of like $20. In their PA, I think they had like 12 or something. So, add some margin of safety. 10 million ounces of year of production. I rounded that. I could see 271% upside in Blackrock if this is in production with 30% capex dilution. It's not even a high capex project. My point is like, and oh yeah, that's using $4,000 gold and $50 silver. So it's like if it's cheap based on that, again, what is priced in already? Might be the equivalent of oil being at $200 or something. I don't know. But again, it's not about the price or value that people are selling. And remember, it's like if you think the market is always right, etc. Why was there probably record volume around here if this was going to happen, or why were there people selling this period of time if this was going to happen, or why was anybody selling anywhere around these levels if this was going to happen, and why were people selling here if you were going to be up 382%? Market has no idea what's going to happen. I like to remind myself that 1 in 20 beats an index. So that basically means that anytime you buy something, there's probably an de facto idiot selling to you, and every time you sell something, there's probably a 95% chance that there's an idiot buying from you. Why is that? Maybe good to remember. It's, in my opinion, simply to not take the market too seriously. In my head, I think everybody that sells a share to me is making a mistake. That's in my head. I mean, that one could consider that arrogant, but it's like we're stock pickers. If I thought the market was rational, why on earth would I even do stock picking? And even though I knew with like 99.9% certainty in 2024 that the next big move is going to be up, and everybody should see that because it's called a cyclical sector for a reason. How many actually believe that? Not many. No, almost every person on earth is an absolute trash investor. So all the trading you see happening is from trash investors. Not because they're dumb. It's the same in poker. It's like it's not necessarily the smartest person that makes the most money. It's the one who actually can keep their emotions in check. And in my opinion, when it comes to investing, it's like patience, common sense goes a long way. Because I didn't feel like a contrarian. When I buy low, I don't feel like when I buy cheap, I don't feel like a contrarian. What is so contrarian about seeing something that's obviously undervalued? I don't feel brave when I'm buying cheap. It just feels like it's common sense. American Eagle is actually never really owned this one, but I think they recently did a financing with like two majors. I think participated on increasing their stake, whatever. Not a big position. BC Discovery looks pretty nice. This kind of looks like I guess a bull flag on some variation. But it's like yeah, there's stuff out there. It's like, but it's every case is different. It's like Tectonic, shit ton of money, early stage. Could be a huge project. Could also prove not to be a huge project. But yeah, okay. Case could be give these guys 2 years and $92 million. If the Flat Gold project is a very large gold deposit or gold system, you're probably going to make money on it because it's going to be obvious within 2 years and $92 million spent. And you look at, again, just factor in that, okay, let's say that happens, or in 3 years, it's obvious this is like 5 to 10 million ounces. Who knows? Maybe even more. And pick a number where gold might be. Yeah, could that be a multi-billion-dollar story? Yes, it could be, Snowline-esque, I guess. Is that a guarantee? No. But if it happens, you would get paid multiples, so you don't even, maybe, if you think that's a 25% chance, maybe that's, good enough. Cerro De Pasco, I mean, they recently put out that good news, which I think also means that there's an increased likelihood of future news being positive as well, like increased likelihood of getting permits, increased likelihood of getting cheap funding, etc., etc. And it's lower now than when they announced it. And I don't think this is particularly sensitive to if silver is $100 or $80, or if the oil price is $100 instead of $70. Yeah, it's a big project. Sierra Madre, not the early stage exploration story. And we're also seeing this, which is kind of not fascinating, but it's like you can tell which are the or typically more like beta, whereas these discovery plays, they're not acting the same. Now actually exploration seems to be getting some traction, right? Because this was an exploration story, Tectonic, 2 years ago as well, but it had 1/5 of the market cap or something. With that said, right now, given that some beta plays are going like this, I'm more inclined to value shuffle into birds in the hand stories, because they're more obviously, they're just getting, they have a bird in the hand that's getting cheaper than maybe some else that is like, yeah, I could certainly see it's like there's a reason I own the stock, but it's still speculative, more speculative, has a higher chance of potentially becoming a bigger, more of a multi-bagger than, let's say, for example, Blackrock or Sierra Madre. But that comes with more risk, because they might also end up not proving up anything worth mining, theoretically. So in no case is the same, of course. And yeah, I mean, American Eagle, they have third-party validation from 2 majors saying that we see there's potential in that project, and I think their market cap is maybe 230 million or something. They are porphyry, so it's like, okay, we know that those large companies, I mean, they want to mine something that's worth a couple of billions, I would think. So I don't know how far they are from proving that up, but let's say there's a 40% chance they're gonna, at the end of the day, prove up something that's worth for a major to mine. Yeah, obviously I could see it go quite a bit higher, etc. As always, I don't have a crystal ball. I don't know exactly what I'm gonna make on any one story. Some of these might fail, especially the exploration stories, but the exploration stories that make it might return much more than the lower risk bird in the hand type stories. And as of right now, I do think that it's the bird in the hand stories that have been getting de facto cheaper, let's say, than the so far successful explorers. So I'm actually value shuffling a bit. I added B2 Gold a few weeks ago, added to the hodl folios as well, because it looks so damn cheap. And then B2 Gold came out with a worse financial report than I expected, but it seems to have been so priced in that the share price just went down like 6-7%, and then it went higher again. So made some money on that. Again, buying cheap is the best offense and defense. And so I've been shuffling that a bit. Or let's put it like this. As of right now, with B2 going higher on a worse financial report, it still looks very cheap, and especially if they execute, that could go up multiples from here if they actually execute on their growth and all that, sure. But, well, at the same time, some of these juniors, if they get cut in half with an intact case, it's not as low risk maybe as B2 gold, but hey, I mean, these kind of short-term corrections, let's say, because of emotional retail, I mean, it's like these ones can pop quickly, much more quickly than B2 gold, for example, because they, went down for less of a reason, let's say. This is not a buying recommendation or selling recommendation. Who knows, maybe B2 gold will outperform every single junior I recently used those proceeds to buy. I don't know. I don't have a crystal ball. But I cannot help myself. I like big corrections. I like when sentiment is getting worse, the downside trends are getting extended, because it means I'm more and more likely to make money when I buy shares, because there's more upside and maybe hopefully more probable upside as well. I guess the closing thought is gonna be remember that in a bull market, like a proper bull market, this is pretty much what the sector and stocks are gonna do. And even if you buy here at the end of the bull market, you're gonna make a lot of money. Maybe you made double the amount of money at this point in time. So again, it's just that in intact stories, as the price goes down, the buying opportunity goes exponential. Less upside here compared to here. A lot less upside and shorter time frame. So the difference from a compounding perspective is more than the percentage difference you see here. So if you're selling something that's down a lot, a junior that's down a lot, you should be very sure that it's for a good reason, that the case is not intact. Because if it's an intact case, it simply got flushed due to sentiment, that might, at this point in time, might be some of the best buys you're gonna make for the next 5 years. You never know. And I would say it's probably, I mean, the good thing also about corrections is that it flushes out your conviction. Let's say you have 20 juniors you own. All of them get sold off. There's going to be some cases that you know better, you know why they're cheap, you have an idea what the news releases are going to be in the next 12 months, which nobody gives a shit about now, especially if they're more than 3 months out. So you have that, you know that they're going to put out an MRE and a PEA, or they're going to drill some target which you think is great, and it's already cheap based on what they have at these metal and oil prices and rates and yada yada yada. It's like, it's hard to stack the odds in your favor much more than that. And the more it goes down, because the short-term trend is down, yeah, I mean, some are gonna feel, I think, I hope, like auto buys. But if you have no idea what you own, like most people, you're just gonna get scared. You're just gonna get scared, and you're gonna. Most people, sooner or later, they turn from whatever idea that they were a value investor. Let's say Blackrock Silver goes. I mean, now they might suck it up, and it's like, yeah, I think it's cheap, yada yada. Let's say it goes down there. Here they probably can't take it anymore, and they actually do sell out. And let's say this is in fact an intact case. So they sold something that might be up. Okay, this scale is maybe a bit weird. Let's do something like that. I mean, the time scale here is not that big either, because this is just August. But let's say you sold almost 60% future return in 4 months. I mean, that's insane compounding. I mean, my goal is kinda to also keep my expectations in check. My goal is kinda to compound at 50% per year at least, as long as I can. This would be more than 4 times that compounding pace, which is obscene. But of course, if you pitch someone, it's like, 60% upside in 4 months, let's say. I mean, almost no. Well, maybe in 4 months people actually would care. But my point is that people have such outrageous expectations, and that's also the delusionally high expectations is why they can't sit. Why corrections feel weirder. Because let's say in your mind you're like, I want to do 200% in the next 6 months, and you see whatever position you had that in mind in, it's down 30%. The gap between expectations and current reality is bigger, of course. So it's like, it's a bigger difference than, it's like, if I'm okay with getting 50 to 100% per year and I'm down 20%, and I'm like, well, it doesn't matter because I have these catalysts coming up and I think it's going to end up at whatever, 50 or 100% up. Whereas like, oh, if in your head, I'm looking for 500% before the year is over and the position starts to go down, that's a stark difference. So then you're going to be much more likely to panic, because you don't think all of a sudden, it's like, if you have such high expectations, any sort of correction, it's gonna feel like I don't know what, like the house is on fire. Even better if you're like, hey, I'm looking for cases which I think are likely to double over the next 2 years, and I know nobody actually gives a shit about cases like that, and that's why they are around. Then if you're down, let's say 20-30%, you're gonna be like, well, there's whatever 23 months left for that stock to reach a level where I'm up 100% over 2 years. So you're going to be much more chill about it, because it's like, hey, this is just a first inning out of a 24 inning game. Compare that to, I need to be up 200% in the next 3 months, and a month passes and you're down 20%. You're gonna, it's like, it's all falling apart. That's how it's gonna feel like. So just, reasonable expectations in terms of, there's almost no no-brainer short-term case. I don't think I own any case that I think is a no-brainer in the short term. But if you give me 2 years, I can pick a lot of cases where I would be very surprised if I'm not up 50 to 100% over 2 years. And if that's correct, and you can just keep doing that, you have no other option than to get rich in time. But almost nobody on earth has that patience, have those expectations, anything like that. The worst investors aim for the best results. And of course, who have the best results on any given year? Those would be the gamblers. Who have the worst results, which you'll never hear about, any given year? There are also the gamblers. If my goal was to have the best results on Twitter this year, I would need to take a lot of risk. And it might end up with me having the, whatever, blown myself up, basically, the portfolio. So, maybe closing words again. Keep cool, keep calm. Remember that the biggest edge you can have is to be rational in an irrational market. And you can even figure out, like, why is the market selling off? Well, there's a lot of chaos out there. Everybody's talking about oil prices. Trump is kind of panicking. He wants rates to go lower. Private credit is blowing up and all that. Okay, and we think about it, like, is that good or bad for precious metals? I would say it's like, I would be happier to own gold and silver right now, given that we might be on the brink of some, whatever, the financial system having some really big problems. Okay, so why are the mining stocks selling off? Margin calls, liquidity crunches, just classic fear. Have the projects gone down 40 to 50% in the last 2 months? The value of the long-term value of the projects? No. And even maybe the upside in gold and silver is getting pulled forward in time. Who knows? But it's like, if you can figure out why people are doing doing stuff, then it's like, okay, I get it. People are scared, so they're selling stuff. And on any given day, mining stocks, even though they have gold and silver, are still stocks. It's risk on capital, even though the underlying assets are risk off. But they get treated as stocks. That's obviously an opportunity there. Where the very thing they have a business around, which is precious metals, hasn't really gone down much in price and is near all-time highs. But the cost of buying that stuff might have gone down 50% in some cases. That's a pretty good deal. And of course, like always, what everybody's talking about is pretty much priced in. And like I said in my PDEC presentation, I typically don't care much about macro. What is the long-term value effect on some Canadian gold project that there's a war in Iran right now and oil is at $100? How much does that impact what a mine would make in 5 years with a 15-year mine life? I don't even know where gold is going to be in 5 years. But is the market so smart that it means it's for sure 50% less than it was 2 months ago? I mean, fuck off. That's not how the market works. Remember, there's like the average holding period of a stock, I don't think has ever been shorter. So never before has more people simply bought and sold stocks depending on what they think is going to happen almost literally tomorrow than now. And that's why, in my opinion, why the bottom in 2015 was the most ridiculous mispricing of the mining sector I've ever seen. So the question is, okay, that was the most irrationally priced mining sector maybe anyone has seen in 40 years. Well, what does that tell us? Oh, all right, that means that our competition is more irrational than it's been in 40 years. And did that competition suddenly become rational? I don't think so. That's good. Means that rationality is maybe at peak value. Common sense for sure is, sure as shit is. Yeah, and also with the value shuffling, I think it's natural. It's like I didn't finish my thought, I guess, about let's say when you're value shuffling, high grading the portfolios, like some cases you're gonna know better, intuitively feel are less risky, because if you own 20 stocks, they all fall. It's gonna distill basically your conviction. You're gonna be more inclined to buy some of them for whatever reason. They're higher grade, higher margin, less jurisdictional risk, or whatever it might be. So usually I think near bottoms, my especially now, I was gonna say, it's like I probably tend to concentrate all of a sudden. Because some cases are just better, or let's put it like this: if 20 cases go down 20%, the one with margin of safety go up quicker in terms of risk reward, because you're getting a bird in the hand 20% cheaper. Whereas 20% discount on a speculative play is not as real in a sense. Not as like free money, because it's still speculative. Meaning, yes, I'm getting 20%, so the risk reward is getting better because I pay less for the potential upside. But at the same time, if you have something with obvious upside, margin of safety, that goes down 20%. That's more like solid free money in a sense. So I would absolutely not be against just maybe concentrating a bit in your I mean, it's like why beta was so bird in the hand, sunk cost, etc. was so cheap 2024, well, last year as well, because you weren't taking any risk and it was just obviously free money. And now, yes, some stuff like that has gone up, but now it's going down again. And the expiration stories are, some of them are kind of holding up there. So the birds in the hand are getting cheaper, quicker recently than the birds in the bush. But I'm buying expiration companies as well. Anyway, I mean, again, not investing advice is like, if you can't stomach this volatility, or the idea that we might have a 2008 type crisis in the future, and you really can't stand having 50% paper losses from here, and you're going to sell low, I mean, you should probably not be in this sector to begin with, because nothing is going to be more expensive than selling low. But in my mind, I'm kind of looking forward to the test. This is, I mean, yes, we're getting some flushes now, but it's like, if in some names we go down 50% more, and gold and silver doesn't really go down that much, and what's going to happen after a crisis, man, I don't know what some of these juniors might do after that. We might have like 2008 to 2011 type returns, where it's like the average junior goes up like 1,000 to 2,000%. I don't know, but I'm gonna find out if it happens. I am absolutely not gonna be selling low unless there's a whatever meteor coming or something, and in that case it doesn't matter what our stock portfolio does anyway, and Nasdaq is not gonna save you. Thanks for listening. Not buying or selling recommendations, and note there's like, if I'm buying some of these because they're dipping, I might value shuffle if some other fall even farther 2 weeks from now or next week or whatever it might be. So that's why this is not buying or selling recommendation, because I anything can change, because it's up to the market. I don't try to force opportunities. I take them as they come. I don't try to predict the market. I'm trying to take advantage of the market. Consider me biased. I think I own shares of all companies I mentioned. Some might be banner sponsors as well. Don't invest money you cannot afford to lose. Again, I have no idea if we're close to a correction in some names being over. I mean, a lot of them probably should have bottomed yesterday because they are that cheap. But I don't know. I can't predict human nature that well, except that it's unpredictable. So it's like, be prepared for anything, but also the most important thing maybe is like, if you understand how the market works, how panic works, etc., it means that you're psychologically also prepared for panic to happen. So just knowing the fact that yes, a lot of these names are very undervalued right now, but you also know that it's because human psychology and liquidity crunches and margin calls, it means they can also get even cheaper. Like, I mean, this was absolutely ridiculous 2024. It was probably already ridiculous in 2023. That didn't mean they couldn't go lower. But once it was over, as we see in GDXJ at least, one of the most epic rallies this sector has seen in 15 years or more. So be prepared for anything, but if you know why it might happen, you also know that it's probably going to be emotionally driven, and then you can figure out what to do because you know that sooner or later the market turns from a voting machine to a weighing machine. Anyway, thanks for listening. Bye bye.